In this video, traders, we're going to look at should you use guaranteed stops. Many brokers are offering this service now. Stay tuned to find out my opinion. Hey guys, well, welcome to you. Right, so this is my opinion on things. Obviously, take your own risk tolerance into account, all that other good stuff, understand the risks. You know the score, guys. You know what trading's like. Potential for huge rewards, can be very rewarding occupation, potential to blow up as well. You probably know the score if you're here. You've ridden this roller coaster already on your way up to your trading goals. Okay, so guaranteed stops. Many brokers are offering this thing, and what they basically say is this. They say, okay, you know, normally you'd have a position on and you'd go right here, I'm gonna go long here, and I'm gonna put a stop loss. Let's change the color slightly. I'm gonna put a stop loss here, and then go fine. You put your order in, you put your stop in, you pay your spread, off you go. Now, what happens if the market the next day gaps lower and opens up here, say? So imagine this is 1 day of trading, and imagine next day opens up here. What happens? Well, unfortunately for you, you get stopped out at this level. So imagine if your stop was here, and let's say if it was at 50, and let's say the next price that it opened at the next day was 40, whatever the kind of numbers before that were, you are going to be filled at 40 if you've got a stop market order. If you've got a stop limit order, you won't be filled, it'll just be sitting as a resting sell order. But don't overcomplicate things for now. For most people use a stop market order, let's lose that one. So what would happen is if it gaps lower, suddenly opens at 40, you're going to get stopped at 40. So you can have a massive $10 slippage. Now, think if it was even worse than that, it's sitting open up at 20 or 10 or 5. Wow, you've got a huge slippage. Now, for most things, this isn't going to happen. You know, for most instruments, the likelihood of this happening is reasonably slim. Now let me just qualify that very carefully before I make that sweeping statement. If you're trading Forex, you can trade 24/5. Most providers allow you to trade all through the evening. The price is open from Sunday night all the way through to Friday evening. All you've got is the weekend gap risk. Now, of course, we have had various instances where prices gapped heavily because of weekend news, and you've had a situation, maybe it's gapped 400 pips, your stop was 50 pips, well, sorry, you've taken 350 pip extra loss, which you probably didn't want to have. Very, very rare for it to happen, but it does happen. Now, to mitigate that, it's an understanding of what's happening in the environment. Is there an election coming out of the weekend? Is there some sort of agreement? Is there some sort of news? Is this? Now, obviously, you can't always mitigate this. There are kind of surprise news events that happen regularly, and something could happen, and that could gap down, and you could be in trouble. So that's Forex. Reasonably similar with indices. Most of the time, they're allowing you to trade almost 24/5, depending on who you're trading with. Stocks a little bit different. Stocks or shares, UK exchange, German exchange, US exchanges, they'll close in the evening and then reopen. Now, you've got gap risk then every evening. So this is when maybe you think, oh, I've got a bit more gap risk. Now, if the market should suddenly rip on you intraday and you've got to stop in, I'm going to say that most of the time you are going to get stopped out. Now, you might get a bit of slippage if it's a fast market, but most of the time, the market will run through and you'll get stopped out, and you'll probably get an okay stop. So the only thing you're really protecting yourself against here in the guaranteed stops is gap risk. So the point is, should you use them? Now, my opinion is you shouldn't use them, because what you're doing here is you're paying an additional fee to insure against gap risk. That's basically all you're doing. The provider is saying, hey, we will cover the loss for you if it should gap. If you've got to stop at 50 and it goes to 40, we'll still fill you at 50, but we'll charge you a bit extra having that guaranteed stop. We'll charge you insurance. It's an insurance policy you're buying. And my general thing is on insurance policies is, hey, if you can self-insure, and again, personal preference on this, you know, do your own kind of research on the risks involved with it. But hey, I'm just kind of sharing you my thoughts on this. If you can self-insure, then it's going to be cheaper in the long run. If statistically speaking, you might be unlucky, want to get caught out. That's the same with anything you self-insure. You might be, but the insurance company is there to make a profit, as these guys are there to make a bit extra. That's why they provide the service. They think, okay, well, if we provide this insurance for most people, every so often we'll have to pay out in terms of some slippage, but the premiums we get in will way outweigh that, and we're able to make some money from it. So I always think on the flip side and go, well, you know what, I'll self-insure and I won't pay for a guaranteed stop. And the thing as well, guys, the guaranteed stops normally are quite wide, so you can't have a tight stop and then take advantage of the fact that they'll insure you if you get like 10-point slippage. It's normally quite wide and it's like an extreme event, so you're only really insuring against an extreme event. And I think you can mitigate the risk on this by A, not holding stuff over earnings unnecessarily, B, not holding things over the weekend that maybe there's some potential weekend risk. Of course you can't eliminate surprise news, of course that's going to happen from time to time, but if you kind of think about where the risks are coming from and make a common sense approach and go, oh, you know what, there's some news coming out this weekend that could gap my cable trade, I'll close it and I'll reopen it on Monday, then I think you can mitigate most of the risk. Now, you can't eliminate all the risk, of course you can't, but to a certain extent I think the risk is low. One more thing, if you're trading from the European Union, the ESMA rules state if you're a retail trader, your account can't go negative, or if it is, it's reset to zero by your broker. It's negative balance protection, it's called. So one thing you can do if you wanted to kind of hedge yourself a little bit is take out the money, all your surplus money, apart from the margin required to kind of fund the trade, and then if it does kind of stop lower and rip through, you've got the negative balance protection anyway, and it won't chomp into some of the account that you've got, so you kind of can leverage on that. That was supposed to be used, perhaps not, but hey, that's what it is. The rules are there. That's the retail rules. If you're trading as a retail trader, they're very different if you're a professional trader, very different if you're in other parts of the world. So something to bear in mind. So should you use guaranteed stops? I don't think so. Let me know in the comment section below what you think. Now, some brokers offer guaranteed stops. Some call it other. They're wrapped in other ways. They call it other kind of trademark things. I can't really remember what they call it, but like refunding losses. Basically, insurance policy. The idea is you pay the little bit of a premium. So let me know your thoughts in the comment section below, guys. Should you use guaranteed stops or not? And have you been caught out before that makes you think, you know what, I'm going to use guaranteed stops? Take care. See you next one. Bye-bye.